Hey everyone, welcome again. For those who don't know me, I'm Litan and I'm one of the co-founders and the CEO of Vyzer. So today's topic is an interesting and important one that Mike and I and Hans have a lot of passion for, which is, going over deals, decks, PPMs, everything that sort of we've been doing since we've been investing for many years and saw a lot of red flags that come up. Hans, Mike, and I have been doing, over the past, I think, year or so, we did a bunch of, pitch deck reviews. We have our own sort of YouTube show that we had GPs send us their pitch decks and we publicly reviewed them, put them on YouTube so you can go afterwards and check those out as well. Hans is one of the sharpest side thinkers I've ever met. He is so good at going through decks, deals, and I think this is going to be a super interesting conversation, diving into the different aspects, everything that has to do with fundraising decks for private equity, private credit type stuff, maybe even more than that. So, Hans, welcome to the show. Super excited to have you join us. It'd be great if you can give us a couple minutes sort of background so everyone else gets to know who you are.
Sure. And thank you for the kind words, Tom. Um, so background, I am I originally started as a CPA working for one of the big four, PricewaterhouseCoopers, back long time ago. I'm not going to say how many years. And did that for quite a while, maybe a decade or so. And then I started buying foreclosed rental houses after the GFC. And that transitioned into wanting to invest into multifamily, things like that. Long story short, it is a long story, but I got into one of my first multifamily deals as a limited partner. Um, and this was back like 2009, 2010. And basically, the deal wasn't going well. The sponsor in charge at the time wasn't hiring the management company we were asking him to hire as limited partners because the one he had hired wasn't working. He over rehabbed the property. You only should put rehab in commensurate with the demographic and the level of property you want. You don't want to overdo a property, right? Long story short, he wasn't managing it well, and myself and another limited partner in that deal got voted in by all the other limited partners unanimously to take over the deal. So we kicked him out, literally kicked him out of control of the deal. He still kept his economic, investment and his carried interest, but we kicked him out of the deal. We turned the deal around, hired the management company we wanted to be hire all along, asset manage the deal to a decent sale. I think we made about a 25% return for our investors, and which was really good at that time, considering we were starting behind the eight ball. He had already dug us into a hole deep. This is, a deal that we bought for 20,000 a door to give you an idea of the rough type of property this was back in Dallas back in the day. So we turned the and that's how I got kicked off, started as a sponsor myself. So that group of investors started asking myself and my business partner, "Hey, are you guys ever going to do a deal together, like, and not just, save this one deal? Or are you going to actually go do a deal?" And that's when we decided, no, let's test this out and let's partner together. And that's how we got started. So my background, high level, is CPA to that, and since then. I have probably, my business partner and I have done over $100 million in equity that we've raised for around 25 to 27 deals or so, mainly across multifamily. It's what I've done the most of and what I know the best, and it's what my business partner knows the best. But we've also done some self-storage, mobile home parks, and industrial. And then this is about LP investing. The deal this webinar is, and I'm an LP as well. I probably get close to 100 K1s a year. So I'm invested in almost any real estate asset class you can think of, plus some other stuff like VC, private equity, little stuff like that. But for the most part, I'm heavy real estate, and I've got a lot of K1s too. So I'm an LP just like you guys.
I want to kick it off with a great, because I mean, I know your background, but I still want to kick it off with a really important question based on what you just said, which is you got into this because you were an LP and you had to take over the deal. And you hear that recently when all these GPs or operators or deals are going sideways, where LPs want to understand what their options are to, get some sort of redemption from this, either, take over or, sue the GP or whatever it is. Do you feel like now when you go over decks as an LP, is there a question you ask yourself or ask the GP to protect yourself in a scenario that like that does not happen, that you have the ability to take control? Or is it because if you ask me and I'm an LP, I wouldn't even think about taking control. I'd just find any other legal action because I wouldn't want or know how to take control of the operator. So I'm curious now that you look at decks, do you look at it differently, specifically around that context?
I do look at, and it's not really the DEX, it's going to be your company operating agreement, but I do look at that. I will say that the vast majority of private syndication deals you get in right now, you're not going to have the ability typically to kick the sponsor completely out like we did. In that case, luckily that was written that way back, and this was back, before, this is right when all syndication started. So basically it was just written a little bit more in favor of the LPs at the time. But now really the only way to typically that I do look for is I don't necessarily look to remove somebody just because they're incompetent, because it's very hard to do, and that's typically not going to be in an operating agreement at this time. But what you should look for is whether or not you can remove the sponsor for negligence, and you'll see the words for cause, meaning that they committed some sort of fraud or negligence. And if that can be, proven by the LPs, then you should have that in the limited partner agreement or the operating agreement from the limited liability company, and you should be able to remove them for negligence.
And
Incompetence is
that's hard though.
it is hard to do, but you don't want somebody that is committing fraud to be managing your deal. And in that case, typically what you would do is you kick them out and either bring somebody in that is an expert and is knowledgeable about running a deal, or you find somebody in the partnership. And in our case, myself and my business partner just happened to want to do it ourselves and take it over. And we just had enough time to do it. But you definitely want to be able to remove for cause. Look for the word for cause. That's what you'd want to look for.
Yeah, I've just seen that a lot of times the sponsor will fight it, and if it goes to court, the court will say you can't remove them for incompetence. Like you can be very, very
Right.
incompetent, like really mess the deal up and do really dumb things, and they'll actually be able to use your LP money to fight you against being
Right.
thrown out.
Which is why I'm saying in the company agreement, it will never say you can remove for without cause. Very rarely. But for cause, it's usually pretty cut and dry.
Yeah, the only thing I've seen is some of these the preferred equity things. A lot of times those that like it's the deal was done the first time, and then now they're bringing more equity in to sort of like the rescue capital, either as a loan or equity coming in. Something like that. Often you can get it to where if they don't perform at certain metrics, that new group coming in can take over, and that's something that I
Yeah,
would
that's
definitely want to
completely
see.
different.
Yeah, I
But
want,
that's just a unique thing that is out in the market right now.
so I want to focus on going through deal rooms, like the deck, the PPM, the OM, the operating agreement, whatever those are, and so we can help people understand what they might be overlooking or what they should pay more attention to, and what sometimes is given too much attention, right? So I'm curious, sort of when you look at a deck,
Mhm.
what are the first slides, like two or three slides you look for?
I mean, really, the first thing I'm going to look for is, I mean, frankly, and this is from practice, sophistication of the deck. If it, you know, if it doesn't clearly call out what the value add strategy is of the deal, meaning any deal you invest in should have a value add strategy. It should be crystal clear to you as an investor within the first 10, 15 minutes of looking through the deck to understand what the value add strategy is. If it's not clear and the deck is, if you look at enough decks, you can just tell when a sponsor is sophisticated and put together a good deck versus putting together a deck that just looks salesy and looks simple. Um, I think the first thing that somebody that's learning to do this needs to understand is how do you look for the value add strategy? And is that value add strategy clearly articulated within the business plan itself? When I say business plan, I'm going to interchange that with deck. So business plan, an investor deck, those things are the same thing. It's basically the strategic the it's basically the value add strategy or the strategy that the sponsor is going to implement to create value for you as the investor. It's the plan of what they're going to do with the property, no matter what kind of deal it is.
Yeah, and we've done a lot of decks where there's so much fluff on the front and back end of it, where it's so hard to find. Just like, what are you guys going to do with this? But I'm curious because when you think about a deck and the value add strategy, which is a component of it, what is the second part that you think would be, because that for me is given. Like, I mean, if they don't have that, just like, all right, next one. Like, but all right, let's just say it's given that there is a strategy. They do define it clearly in the deck. What is the next thing you look for after that?
I mean, honestly, I skim, to be quite honest, I don't have a checklist 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I go through the deck at a high level, get a general idea of what the value add strategy is. And you say that that's a given that they should have that. But that happens a lot of times. You can get to an entire deck that looks really nice and they didn't do a very good job. And you realize that their entire strategy is built on a compressed cap rate at the end, and they grew the rent at 5% per year instead of what standard market is. And they didn't really have a true value add strategy. So, really, I will skim through a deck, find the value add strategy, understand the waterfall and the fees, I think are two things that I'll jump to immediately just to get a sense of what their waterfall and fees are. And that'll start giving me a sense almost immediately after 10 minutes of how sophisticated they are and whether or not it's something I want to dive into deeper. And this is with the assumption that I'm okay with the market, with the state that they're in, the market that they're in, and the asset class that they're in. If I'm giving that as I won't even look at a deck, say that if somebody gave me I don't know, honestly, if somebody sent me a multifamily deal in Illinois, and I'm in the Sun Belt, I'm in Texas, I wouldn't even look at it. I mean, because I have no desire to invest in a blue state with landlord laws the way they are. It's not something unless I knew that sponsor personally, it's just not an area of the country that I really personally want to invest in. I'd rather invest where it's business friendly and where things can't be changed in the middle of a deal that will affect the deal itself.
Yeah, but I agree. But there have been decks that we went over together that they didn't have a track record in the deck. They didn't have a financial plan in the deck. And even if they did
Right.
lay out their strategy, it's not, I mean, okay, great, but what else do you have? And if you're not showing that, that is a red flag. Like, that maybe lower, let's just say the strategy is clear on a few slides, but they don't have that type of stuff. Those are red flags, I'd imagine.
Yeah, there's a million red flags. I mean, there's right. And so that's why I'm saying there's not a 1, 2, 3, 4, 5 thing I look for. I skim a deck, and you want to have a business plan or a value add strategy. You want to clearly articulate your fees. You don't want to have the investors dig for fees in a 30-page deck. It should lay out the fees and waterfall on one or two slides. So it's very simple for an investor to understand what the fees and waterfalls are. You want financial projections, as you mentioned, Litan. You want to be able to go to a certain page there and understand here's how the deal's performing today, and here's the pro forma 1, 2, 3, 4, 5, the years, and how is it going from total revenue all the way down to investor cash flow. You want to understand that. And yes, you do want to have something that points to their track record, how they performed on the same asset class with the same types of deals in the past. So all those things are important. And any one of those things can be a definite red flag.
Yeah, it's interesting because I remember we went over a deck at one point. It wasn't even a deck, it was more a PDF document that someone that we like actually sent us. And, it was just, it was clear exactly what they're going to do, the track record. It wasn't a beautiful deck, but it was like a 2, 3 page PDF that had all the information we needed to go through. Also, and it is important to also mention, usually those types of decks are good when you already know the GP and they don't need to talk and explain who they are and what their background is and if there's a capital raiser involved and all that type of stuff, right? Because we've seen decks as well where it's a capital raiser who's raising for someone else's deal, or it's a co-GP and they're not really diving into, or have they done deals together in the past? And so there's the deal itself, but then there's the structure of the partnerships between the parties at hand, right? Which is also another aspect. I know we can't list out all the red flags. There are thousands of them, but I am interested to think, like, for the both of you, Mike as well, what are those like top red flags that we'll see going through a deck that people don't pay enough attention to, right? So we mentioned, all right, not the track record doesn't mention anything that they've done before in the same asset class, same geography. The strategy is not clear. The performer is not there. What other, like, red flags that would be in that deck? You guys would say, oh wait, I need to ask questions, or this is something that maybe just pushes me totally away from it.
I mean, one of the things that I see sometimes, especially in a value add multifamily, is where the first year they're planning to implement, like, let's say they're going to do, they're going to turn every unit and they're going to increase rents and that kind of thing, where they're not showing that drag of these empty units and that aren't producing for that time, and then re-renting them and that kind of thing, where you get somebody that shows like, oh, our rents are up 22% in the first year. It's like that just isn't likely possible because of the time that it takes to turn things and to do the value add strategy. So there's some things like that you can see right away. For a while, it was things like insurance, or in some states, it's taxes, where if this hasn't been, if it hasn't turned over in 12 years and now all of a sudden you're turning it over, you could have a situation where the taxes within a year are going to be, 3x of what they have been or something. So looking for a few things like that.
I mean, again, yeah, that's one of them, right? You just look at the the current performance of the deal, look at how much income increases for the end of pro forma year one, and if it's a ton, then you need to start diving into the details. What Mike's talking about is basically what a lot of new sponsors or aggressive sponsors will do is they don't really take into account the fact that there is a set turnover on a property. You can't just turn all the units on a 200 unit property in 1 year, right? Typical turnover on a multifamily deal is 40 to 60%. You're just not going to turn it that fast. Usually implementing a value add is going to be a 1 to probably 3 year deal. Is usually going to be a 3 years to stabilization. So you should see it slowly build. You shouldn't see it jump to year one. And that makes a hell of a lot of difference if something goes from year one and then you grow 3% a year from year one versus taking to year three and growing 3% a year. You're doing a 5 or 7 year deal mathematically. Everyone here is smart. That will cause the IRR just to jump. You know, and the track record, I look for people that a lot of new sponsors will have higher IRRs over the last few years. And that's because a lot of them were buying deals in 2019 and selling them in 2021. They're flipping deals really quickly. So they're making, the faster you sell a deal, the higher the IRR typically, because IRR is based on the time value of money. So you got to look at the ways that they're getting their actual returns on their track record. And many times what I'll ask for in situations like that is, I want to see what their projections were, and did they hit projections? I don't care what the IRR was, but were their original projections on pace, or did they just make their high IRR because back in those days the cap rates were compressing and anybody that could fog a mirror could buy a multifamily property and make a ton of money because cap rates were going down. There wasn't anything they were doing, in other words. I want to see if they
Yeah.
actually implemented their business plan that they outlined in their deck in that prior deal and that track record, if that makes sense. So a
I think
lot of
what you're
this
saying is, did the net operating income actually increase,
yeah.
something that they had control
Well,
of?
yeah. Did they actually do what they said they were going to do? And then the cap rate thing was just gravy on the top, right? Things like that. I mean, it's again, I could name a million different things to look for here. That's why I have a presentation that I gave a 6 hour presentation on for this. So, but I think those are some of the biggest highlights really that people need to look for. Anything that's super salesy, quite honestly, I am almost immediately out on. If it comes across as salesy or just kind of unsophisticated. A good sponsor with a good track record doesn't have to be salesy. He or she will put out the business plan and lay it out for you, and that's all they need to do and show their track record. If it's salesy or they're pushing you to invest, another big thing, I keep thinking of new things when I'm talking, but another big thing is if you ask a few questions and you're not getting super transparent answers from the sponsor, that's a definite red flag. If they won't share their model, share things with you, that's a red flag. They should be 100% transparent with you when they're trying to raise money for a deal. And I've noticed a lot of new sponsors, again, won't be transparent or won't answer questions clearly. And that is just those are all little clues that'll start cluing you in on how they're going to treat you as an investor during the deal. Because I always say, if somebody doesn't treat you transparently up front and answer questions quickly and clearly to you when they're trying to get $50,000 or $100,000 from you, how do you think they're going to treat you if the deal goes bad and things aren't going well? That same person is going to disappear on you typically.
Yeah, and
I
Anoop,
saw.
Anoop, I see your hand up. I just wanted to say one thing on that because it is important to emphasize, at least from my point of view. Sometimes sponsors will not put everything in a deck, and it's annoying because you want to see everything, but it's possible they have all that information
Yeah,
in other documents,
oh,
and you might just need to ask for it. So
that's
it
right.
so it's important to say it might the deck from a marketing standpoint might not be good. That doesn't mean it's a bad deal. It just means maybe the GP didn't put together the documents that you wanted to see, and you should just ask for them, right? Just
Yeah,
important.
and when I say transparency, when you ask, they should produce, right? So
Exactly.
you're totally right.
Uh,
And one more quick one before we answer the question. Um, Financing. You know, one of the big things that I'll look for immediately in a deal is to see how the deal is being financed. And that weeded out a ton of deals back from like I'd say 2019, 2020 through 2023, where we had a ton of people in the multifamily space, and they were almost all, not all, I mean, there was sophisticated sponsors that did this too, but many of them were using bridge debt, floating rate debt, at very high leverage points, deals that were stabilized, essentially that deals that didn't need bridge debt. And this is a whole, discussion in of itself that we don't have time for, but bridge debt should only be used for distressed properties that actually need a bridge. That's the whole point. It's bridging the debt until you can get permanent debt. And many sponsors were using bridge debt as quote permanent debt to acquire deals because you with the floating rates and high leverage, you could make deals work in terms of cash flow for a while as long as rates stayed down. Well, we all know they didn't. So that's those same sponsors got bit pretty hard when rates went up 500 bips over the span of like less than a year, right? So I want to see responsible debt. You're getting into bed with the sponsor for the next 5 to 7 years, and your biggest partner in any of these deals is your lender. So it needs to be responsible debt.
yeah, Anoop, go ahead. What's up?
Um, so a few questions. I'm going to stick with the multifamily theme just for a bit. So having looked at a lot of decks, it seems like every single deck has got the same kind of couple of slides. One is, hey, we have a lot of proprietary relationships and most of our deals are off market and never kind of go through an auction process. A lot of them say, hey, we have proprietary relationship with from different banks and financing agents, and we get rates that no one else really gets. And I have a hard time really kind of taking those things on a slide and be like, okay, obviously everyone can't claim the same thing in terms of what their secret sauce is. How do you really kind of pinpoint a sponsor saying, okay, well, now prove this to me. You made this kind of conjecture. Show me like how you're really different than every other sponsor that's claiming the same thing. That's question number one. The second question is that the things that kind of get me most comfortable are things like, hey, who are your other LPs? Like, do you have, for me as a retail investor, to go into a fund that's got two, three, four institutional level LPs that are committing, eight-figure sums and above, that makes me feel a bit more comfortable saying that there's a level of due diligence that an investment committee has done. That just kind of gets me to the finish line. The other thing that gets me to the finish line is, skin in the game. If a sponsor says, hey, I've got 5-10% of the capital raise that's coming from me, that's meaningful, but I have a hard time figuring out, hey, is that sponsor going to sell that 5% of that 10% on some sort of GP-led secondary market where you think they've got skin in the game, but after the fund is raised, within a year they're out, and so they don't really have that level of commit. How do you kind of really kind of hone into those types of nuances or get that level of information where a sponsor may not be so forthcoming?
Okay, well, with your first question regarding like I heard you say somebody will say they have proprietary debt. That's BS. And when we're talking about multifamily, the best debt is always Fannie Mae and Freddie Mac. And
Yeah.
so, yes, some more experienced sponsors can get better debt because they, you know, but they're not getting different debt. They're going to the same DUS lenders, which is DUS meaning there's only like 25 lenders across the United States that can make Fannie and Freddie loans. They're called delegated underwriting services loans. And so, I can go get Fannie Mae and Freddie Mac debt, and a guy that has done $3 billion worth of business can go get Fannie and Freddie debt. The difference between me and him might be that he's worth $100 million net worth and has 10 million in liquidity. I don't. So he's going to get better rates typically. He'll get more, he'll basically just get slightly better terms than I will. He might get an extra year IO, certain things like that. But we're going to still both have agency debt on multifamily loans.
Okay,
So
right.
there isn't special debt per se, other than you have a strong net worth, strong balance sheet, and really good experience. Somebody that's never done a multifamily deal and wants to go sponsor a 150 unit deal, they typically they cannot get agency debt without somebody else that's part of the deal that has experience. So agency typically wants experience, but there's no proprietary debt in the multifamily world per se. In terms of like deals, if you are very active in the market, yes, you can have access to off-market deals. When I say off-market, that's kind of BS, right? Because every deal that a broker, and almost all deals come through brokers. Once in a while, these multifamily sponsors will find a deal by calling other multifamily owner operators. But the vast majority of deals, whether they are actually listed with like a CBRE or a Transwestern, or whether they're kind of pocket listings, they're going through brokers. And so these sponsors can have special relationships with brokers, especially if they close a lot of deals. So the broker will hear about a deal that a seller wants to sell, and for the right price, they'll take it to the broker, and the broker will reach out to his like internal network of like, here are the 5 guys he really likes to work with because he knows that they had the wherewithal to close the deal, they had the experience to get the debt, and they know they'll close the deal. So they'll bring it to them first, and they'll get first look, right? Before it gets right now, it doesn't really matter whether it goes to the market or not, per se, because there's not a bidding process like there was in 2021, thankfully. It's actually based on the fundamentals of the deal instead of dumb buyers coming in and just bidding up the deal so they could close it. So there is some element of truth to the fact that, yes, the more experience you have special relationships with brokers, and the brokers are going to bring you those deals that you're looking for in that respect. What was your second question? Sorry.
The institutional, right?
Yeah, just like how do you find out like who your LPs are in terms of like really having institutional level co-LPs?
Yeah, I mean that's not going to be easy. How do you say your name?
Anu, yeah.
Yeah, to be frank, if a sponsor is raising money from guys that are writing $5 or $10 million checks, he's not going to raise money from you and I, right? He doesn't need us, right? There are a few deals here and there. Like for instance, we invested in a very large multifamily development project. We, as my company, and we brought our investors in, and we're a subset of the equity, and we're part of a GP fund carry where our LP co-investor, or the LP, the 85% of the equity, is a multi-billion-dollar family office, right? But we brought a big check for this. We brought a $3 million check. I knew the guy in charge of the deal, so we had a special relationship, things like that. But if you or I are putting in 50 to 100 grand in a deal, for the most part, you're not going to be able to find that many deals that are going to have a bunch of institutional money right beside retail.
Right.
It's typically going to be.
It depends on the deal
you have to come through
size.
somebody like
fund
us
size.
to, again, go write a bigger check to go sit next to a billion-dollar family office.
Yeah.
Typically.
Anoop, if you're looking for that kind of thing too, you may want to look. There's multiple levels in this. There's sort of the people that just get started and are doing small raises. There are people that have been doing things for a little while and they've been going there. And then what you're talking about is getting into that like almost institutional or institutional level, and then you can sort of say, okay, I've got that level of help. And there's pros and cons with that along the way. You certainly get a lot more experience, and you get some sophistication and other people coming alongside you doing maybe more due diligence, but they're forced into larger deals that have more competition. And so they may not have the returns that some of the medium-sized or smaller deals have. But that's just a trade-off as an LP investor that you have to kind of come in and decide. But in it's just, I think that's a function more of the type of deal that you're getting into, the type of sponsor you're working with. And typically it's going to be a fund too, instead of an individual syndication.
Yeah, I was a little surprised. There is one fund out there, and I'll just mention one name. It's been around for a while. It's very common with a lot of retail investors at the MLG kind of multifamily fund. I think they're on like fund, I don't know, 7 or something like that. And it's it's a big 9-figure fund. I think it's like 250 or $300 million. And if you ask their IR team, what's your average check size? It's typically in that 50 to 200,000 range. They don't have anyone that's writing $5 million checks on a 250 to $300 million fund, which is purely just all retail investors. And that really never made sense to me. It's like, why do you have such a big fund and you haven't kind of gone to that institutional level yet? I don't know what's a good thing or a bad thing. It's a warning sign or something.
It's not good or bad. And I think a lot of people like get stuck into like trying to make everything black and white. Everything in real estate is deal by deal. And Mike is right. You're more likely to invest beside a big fund, a big investor if you're in a fund. I'm in a very large industrial spec fund. They're developing, spec and build to suit, huge, like massive industrial deals, like Amazon level deals across the country. And I have $250,000 in that deal. And then some of their co-investors have checks of, I think, upwards of 50, 60 million, more than that, maybe 100 million, because this is a large, like $500 million fund, right? And they have insurance companies coming in beside us. Now, whether or not they're getting better terms than me, they probably are.
Right.
But I am still investing in the same deals with them, if that makes sense. So it's really deal by deal. And you had a third question.
The third one was, when you think about skin in the game or GP level commit.
Oh, yeah, you got to have skin in the game. That's a given.
How do you know that they're just not selling that the back end on some sort of secondary market, saying, "Hey, we're going to put up 5% to 10 million," but next thing you know, they're barely in it?
Well, number one, you asked that question up front. I've never actually come across that. And
it's not easy to do either.
Secondary market is not easy because there'd have to be a significant discount for somebody to go in and buy an illiquid asset like that. And then if you're in charge of the deal, for you to go then put your 100 grand in the deal and then you're still running the deal and then you go sell your 100 grand to somebody else, that's I've never even heard of that before.
I haven't seen that either.
I've never seen that.
Yeah, I've heard of
that's the
funds
least of your worries right now in terms of vetting deals. There's many other.
I'd say it's rare, but I've heard of funds who supply capital to GPs for their own.
That's different. I'm in one of those. We invested in one where this was the deal I was just describing. It was a massive raise. And so the GP needed to bring 15% of the equity, but the equity on the GP was going to be like, $15 million, right? It was $100 million equity raise maybe or something. So there's no way that this guy he didn't have $15 million of cash to stick into the deal. Net worth might not even be that. And so he had to raise money as a GP, and we came in as the GP, part of that GP fund that was funding the 15 million next to this multi-billion-dollar family office. And for that, we actually got a kicker of the carried interest. So we're actually going to make a better return on the deal than the family office will. That's the GP fund, but that's completely different.
But to Anoop's question, in that sense, like if the GP in that case was saying, I have 15% skin in the game, he doesn't, right? Because he raised that 15% from other people.
Well, he's responsible for $15 million. He does to that multifamily office. That GP has 15 million that he's responsible for, and if he loses that money, to them it's just as like he's responsible for that money. He doesn't, it's when you get to that level, it's a different set of. Nobody at the level of what I invest at and where our deals, where we put money in our deals, I'm not going to go sell my GP interest.
Right.
That's how I make my entire living, right? That would be just. I mean, just ask the question if you're worried about it, but I've never seen that happen at the smaller.
The only thing I've seen sometimes is where somebody, let's say it's an $18 million raise, they get 15 million, raised, and they need 3 million more. They maybe the GP sponsor has a line of credit. They throw 3 million in to close the deal, or maybe they need 2 million of the 3 to close the deal. So they throw that 2 million in, and then they're still going back and trying to backfill that and raise it. But it's not from the beginning said, hey, this is part of my money in. It's just that they kicked in money to make it work from a timing perspective.
Yeah,
And again, to me, that doesn't
that's
matter.
not it. That's structure. That's different.
Right.
So, Anoop, does that answer your question?
Yeah, it does. It does. I had one more, but I'll wait till later. I don't want to interrupt the
All right.
conversation.
So we have a question from Terry about fees, max fee, and I assume I'm gonna hand it over to you, Hans, but I'm assuming this also is really relevant. Like it depends, obviously, but if we're talking about real estate value add, maybe specifically, can you touch on the fees, like max fees that you
Yeah.
look at?
Sure. Okay, so I'm just gonna like a normal multifamily syndication deal. That's what a single asset deal. This is what I'm gonna. I mean, this will hold true for most. Um, Acquisition fee is typically between 1 to 3% of the deal size. I will say 1 to 2 is more common. Um, I like to see that if the bigger the deal gets, I would think the lower the percentage will go. In other words, what I'm getting at is somebody buys it, and acquisition fee is based typically on the purchase price. That's typically how you see it. Some people base it on total equity. I also don't like that. But so you buy a $10 million deal, 1% acquisition fee, it's a 100 grand fee upfront. Versus you buy a $100 million deal and you do a 1% acquisition fee. Big difference, right? It's more zeros, but it's actually the same. You just got to raise more equity, get more debt, but it's actually the same, generally the same amount of work in a weird way. So my getting at is that typically as the deals get huge, like massive, I don't want the sponsor getting like, a $1 million acquisition fee before they ever do anything with the deal. I would think that the bigger your deal goes, and very rarely have I invested in a deal that size, that you start capping the acquisition fee. So a 2% acquisition fee on a $10 million deal, that's okay with me. A 2% acquisition fee on a $50 million deal, I might push back a little bit on that and try to understand their thought process. And again, this is art. This is not a science. There's no right or wrong on this. You will sometimes see a loan signing fee of about 1%. I prefer to only see that if they're signing recourse debt. If they're signing not non-recourse debt, I don't really like to see it. I do see it once in a while. There's typically a 1% disposition fee, same as the acquisition, but it's disposition upon sale. There'll be an asset management fee, typically of 1 to 2%. And on a multifamily deal, that will be based off of like monthly or quarterly collections, actually rent paid. And then sometimes if there's construction, a decent amount of construction, there'll be some construction management fees from 3 to 10%. 3 to 5 is usually what I see more. But that's really high level, the pure fees that you would typically see in a deal. There are 1,000 other fees that I've seen over the years because I've been in so many deals, but that is like a good box of what to look for on a down the fairway normal multifamily deal or self-storage or mobile home park, things like that. Funds are a little different because it's charged on more about equity being managed versus acquisition fees. But essentially, does that answer your question? I don't remember who asked that.
It's
Is that
Terry. Terry
Okay.
asked it, yeah.
Great.
And again, this is like a development deal would probably be different, right? And funds are also different.
Yeah, for the most part, yeah, development deal is going to have a bigger fee on the construction side because that's how they got to keep the lights on to run the deal. Right,
Yeah.
exactly. And they may have a disposition fee, when they sell the deal. And they'll have an asset management fee and things like that. So
The other things you'll sometimes see, and again, there's no right or wrong, but sometimes people will go really low fees or no fees, and then they have higher splits with it. And again, you have to just decide, does that work for you? And can they keep can they keep running things with no asset management fee ongoing if that's the case? But the biggest thing that I think Hans and I would agree on is you don't want it to be a situation where the GP has their biggest windfall on the day that it closes. That's the biggest risk, I think, where they're making so much in fees that's the majority of what they're going to make, because then the incentive isn't aligned with you as the LP to make sure that the deal goes well. You really want to make sure that they're doing a lot of work and they have expenses, and it's not a problem for them to get paid along the way, and they have to be able to continue to look for deals and run your deal, and have a team. But at the same time, you want their win to be when you win at the end.
yeah, the majority of their compensation should really not come from the fees. It should come from the waterfall structure. And as you make more money as an investor, they make more money. I want the sponsor to hit a home run for himself and get rich off the deal I invest in, but I want it to happen on the back end when he makes the money he said he'd make for me first.
I want to say one more thing about the fees, which also people talk about. I want to also clarify is there's double fees sometimes. So like Anoop, to your point, when you're investing in larger deals where there's institutional money where you can't write a $50,000 check, there's going to be a feeder fund into that deal to offer those lower checks. And many times those feeder funds have their own fees. And so it's important to also ask, what is the fee you're paying into that SPV or that feeder? And is that on top of the other fees that the underlying fund actually has? It's
Yep.
important to make sure you're aware of those things as well.
Yeah, you got to understand the structure that you're investing in for sure. And that's why you got to read the operating agreements and understand the full capital stack of the deal.
All right. Any other questions before Anoop asks another one? All right, go ahead, Anoop.
I'm going to change course here a little bit to more kind of equity funds in terms of private equity or even venture capital. Everyone knows that there's like this been big push to the wealth channel and getting more retail investors some access for private equity funds, even some secondary funds, and mainly through like these evergreen structures. And every single pitch deck, every single sponsor call I've been on always tells me they answer the same question, saying it's the same team working for you on this evergreen fund as it is for the traditional drawdown funds. We basically find the same opportunities and we kind of split them up equally so that it's basically agnostic in terms of which one you go into, in terms of which deal that one goes into. And I'm thinking to myself, well, here I am in an evergreen fund, let's say, because I can't commit to a big drawdown fund. And I'm getting the benefit of the quarterly liquidity, assuming that they don't gate me out. But I'm thinking in the back of my mind, why would any institutional investor even commit to a 10 or 15-year drawdown fund if really like there wasn't some sort of illiquidity premium to generate that in terms of just getting better deals, better underwriting, whatever it is. If it really was the same stuff going into both fund types, then is there any sort of am I getting the same stuff as a retail investor? Because they tell me I am, but then I can't make the case for why any institutional investor wouldn't invest in, a Stepstone Sprim or something like that, as opposed to their drawdown version. If that
Well,
makes sense.
probably, I don't know exactly this, I'm not sure if I remember what a drawdown fund is, to be honest with you, because this doesn't exist in the real estate world. But essentially, if you can't figure out the terms you're getting compared to uh, a different fund, you don't have enough information. You get like there, it has to be in your PPM is where you need to be going to understand the terms that you would get in either one of these funds, and you can just compare them and understand if that
I
makes
think what
sense.
Anoop's talking about is a type of fund where you commit 100 grand today, and they're going to slowly pull that from you over the
Yeah, I
next
mean,
two
we
to
did
three
that on a
years.
fund ourselves.
Then by
That's
like 3 or 4 years in, you start getting some of the things are going full cycle, but they can
yeah.
deploy money up to like 7, 8 years in, and it's somewhere between
What are you saying,
12.
Anu? I mean, a drawdown fund, if you mean that by drawdown, you just mean that they call capital over time. That's all you're saying.
I'm saying that there's been this promise of something, or what people think that they're getting is called illiquidity premium, where hey, if I'm going to give you my money for 10 or 15 years, you should give me 100 or 300 basis points above what you can give me through a semi-liquid evergreen vehicle. At least that's what I would expect if I'm going to give you that money for that long of a time. But all the retail investors are being told is, hey, there's no such thing. You're getting the same thing as the guys committing to a 10 or 15-year fund, and I can't
No, they're
reconcile.
not. I mean, you're not because there's probably fees layered for the retail, right? I mean, you're right. There's always going to be an illiquidity premium.
Right.
If and the question is, what is the NAV you're getting in at, right? Is it even accurate? Because that's one of my biggest issues with investing in any kind of fund that has evergreen where NAV is important. It doesn't really matter for a hard money fund, right? Or a credit fund. I'm in a bunch of credit funds where you can go in and out of the fund. You can make 10 to 15, 20% on the deal. Some of them do have NAV because they get warrants and stuff, but for the most part, I'm not worried about NAV in a credit fund, but in the kind of deals you're talking about in private equity, NAV is so important, and that's why you're probably the liquid funds are probably valuing the NAV lower so that they can give you liquidity, and you're taking a hit to have that liquidity on
Just
the
to
NAV.
just to clarify, Anoop, when you say drawdown, you're talking about a closed-ended fund versus an open-ended fund, correct?
Yeah. Like I'll give you an example. Stepstone is a huge multi-billion-dollar manager. They have a Spring, which is their Stepstone, basically their venture capital kind of evergreen fund, where they invest in secondary evergreen secondary deals in venture, whether they're direct or funds. And then they have a drawdown, venture capital fund 5 or whatever, which kind of takes off every couple of years. And when Stepstone GP goes out and say, "Hey, we're going to buy part of Lightspeed, or we're going to buy part of Excel, or whatever it is," they're telling everyone, "Hey, we're going to put these companies in everyone's bucket," and so everyone gets the same access. But if you're getting the same access and you're getting a different liquidity profile, and there's no delta in terms of what you're getting in return, then that something's got to give.
But
Well,
again,
it's hard
sorry,
to
go.
answer without seeing the 2 ppms,
Yeah.
but the 2 ppms would answer your question.
At the end of the day, just to clarify, closed-ended fund, right? They raise capital and then they deploy that over 4 to 7 years, right? And an evergreen fund, an open-ended fund, they raise capital and they just continue to raise capital. And there's more liquidity in that evergreen fund because people can go in and out and whenever they want. That's the main difference. And so there's trade-offs between the two of them. Now, in terms of the blind fund versus non-blind, that's every type of fund can either be blind or not. So it's not that every open-ended fund is blind and every evergreen fund is blind, right? They can define exactly the target that they're going for. So I'm not really sure that we understood exactly the question around the fees or trade-offs that you're asking about. Right?
Yeah.
But maybe we can take this offline, Anoop. Maybe if you have like specific stuff, we can take it offline and
No problem.
Well,
Thank
one
you.
thing I wanted to bring up, and Hans, you can talk about. So a lot of times as an LP, you want to see a high preferred return, and there's sort of pros and cons with that. So what are your thoughts on that? I've seen sometimes preferred returns, 10, even 15%, and then sometimes people have none. Sometimes, it's 5 to 7. Do you want to talk through your thoughts on a preferred return or pros and cons with it?
Sure. I typically want to see a preferred return. I don't have a hard line on what that number is because it depends on the type of deal I'm investing in. It depends on the risk profile of the deal. It depends on how much experience the sponsor has. It depends on what the splits are above the pref, all those things. But I do want to see typically, I want to see a pref because what it is it's saying that the sponsor has to make me as the limited partner or the investor at least a very minimum return before they start sharing in the upside of the deal. That's really all it is. So, and a lot of people look at that, and they'll see a 8% pref and then a 70-30 split above the 8, and then they'll see the same deal and it'll just be a straight 80-20 with no pref, and they'll go for the 80-20 because the 80 is higher. And you got to look at the math and look at the risk profile of the deal. An 80-20 split is typically going to be if the deal does well, yeah, the 80-20 straight 80-20 may end up being better because you're getting 80% of all upside. But if the deal doesn't do very well and the deal makes a lower return, then that means a sponsor can get you a very low return, say a 7% return on a deal, and still get 20% of all those profits of that 7%. And so he or she could raise a ton of money, and making 20% on a 7% return on a large equity piece is still a decent amount of money for somebody, for a sponsor. So you want typically a minimum return as an investor first, and then splits above that. I typically like to see, and this is so subjective because I saw that question on there, like, what is your max fee? Well, I don't have a max fee. Part of it is the deal type, the sponsor, how much the deal was, right? And I'm kind of the same way with waterfalls. There isn't one type of waterfall that I must have, or that I like the best, or one waterfall that I won't do. It's really based on the deal and the risk profile of the deal compared to the sponsor. The more experience a sponsor has, the better track record, the lower risk the deal is, the more I like the deal, the more that I'm okay with the sponsor taking bigger splits. With somebody that has deep experience, I might do an 8 pref, 8 pref 70-30 up to a 15 and then a 50-50 over a 15 and be okay with that all day long on a sponsor that has shown they know what they're doing. But if somebody is only on their second deal, doesn't have much of a track record, but I still want to invest because I like the deal, then I'm going to expect that their waterfall is going to be much more in the favor of the limited partner. So it's an art, and you don't really learn this until you start looking at a lot of deals and understanding the differences. But overall, Mike, to answer your question, I want a pref and then some split above that.
Right.
One thing about the pref that I think a lot of LPs also confuse it with is the cash flow. And they're like, all right, there's a 7% pref or 8% pref. Well, after year one, why am I not getting 8% cash on cash return? And people, either GP doesn't clarify it or people don't ask the right question,
Yeah.
but there's no connection whatsoever between the pref and the cash on cash. And if they align, that's by chance.
Does everyone on this call understand the difference of what Litan just said? Very good point. That I didn't even think about that because I guess it's kind of, I've just looked at something, I don't even think about it. But
I see people all the time confused on
yeah.
that.
Does everybody understand on this? If somebody doesn't understand, please raise your hand so we can explain it, because it is super important. And I've seen a lot of investors get tripped up, new investors get tripped up by that.
The other thing that I've seen besides that, that's sometimes an issue is, especially if you're getting into a fund that had like a 2-year commitment period, it depends how they're paying out their pref. It's like maybe it's an 8 pref, but they're only going to be paying out 4% cash flow. Well, what some will do is they try to catch everybody up. So if you were the first investor in, you might start getting money 2 quarters after the fund started. But if you're in 2 years later, if they're catching up the pref before you go, it may take you 3.5 years before you get paid anything out, because they're making the first investors completely whole on their pref and bringing everyone forward. Or the next one, the way they wrote their PPM is if they're going to pay out 4% that quarter, everybody gets paid out 4% that quarter. So things like that can be something that makes a huge difference in when you start receiving your cash flow too, based on when you invested.
You mentioned something really interesting and important to talk about. And Hans, I'm curious what you think about this, because I've kind of felt that the term catch up in a PPM is like a bad word. Like, I don't know why it's became that way, but because people, there's a catch up. All right, this is a bad deal. And so what do you think about catch ups?
I have no problem with it, but most investors don't understand it. And you will not see catch-ups as often with newer sponsors or less sophisticated sponsors. You will start to see it more in especially in funds. So I have zero problem with the catch-up. Again, it was my same answer as anything else. What does the rest of the waterfall structure look like? Um, a lot of investors don't understand a catch-up, and I think that is a bigger risk, is not understanding what you're getting into. And I've seen people like say, "Oh, this is a great deal," and they'll compare a deal that has almost the same waterfall but has a catch-up to a deal that has that waterfall but no catch-up, and they don't even catch the catch-up part of it, and
Right.
they don't realize that they're giving up a decent amount of return. So it's
Do you want to explain
something.
for a sec? Why don't you align us what a catch up means?
Yeah. So a catch-up is, let's make it really simple. You have an 8% pref and a 80-20 split above it, just to make it simple, right? So basically what it's saying is that and I'm the sponsor, I need to pay you an 8 pref first. So let's say I'm able to pay you that 8% preferred return. Once I pay that, it doesn't go to 80-20. Then I get 100% of all gain or cash flow until I get my 20% of that 8% that you got. You're catching me up, meaning in the end, it was an 8 pref 80-20. But in the end, if you do everything and go through the entire waterfall, it ends up being just an 80-20 straight split. In other words, I got my 20% on your first 8% after you got your 8%. And then it starts splitting 80-20 for every dollar thereafter. Does everyone understand that? Does everyone make sense? So essentially what you're doing as a sponsor is that you're making sure that you get 20% on every dollar of income or gain on the deal. It's just that you get it after you pay that 8% to the limited partners first.
Yeah, in that example, the first 8% goes to the LP, the next 1.6% goes solely to the GP, and then after that, every percent 0.8 goes to the
And
LP
then
and
1.6,
to the
everyone
GP.
understand where he got that?
20%.
20%
Okay.
times 8%.
Right.
Yeah, the ones where it's really impactful and you got to really watch for are development deals where it's a really high pref and then there's a catch up. So I've seen some things where it's like a 15% pref and then it's a 50-50, but there's a catch up. So when you look at that, the first 15% is going to come to you, but the next 7.5% is going to go solely to the GP if it's 100% catch up. So that's something where you get the first 15, but it has to go up with 22.5% total return before you get anything more. And so you're kind of capped unless you think this is going to be something that returns like at 30. And then you're only going to get that another 3.7%, 75% on top of it. So even though it's a 30% total return, because of that catch up, you're getting basically a 15.
Yeah. All right.
And on a development deal, you can get into crystallization, which is probably too far for this conversation, but it is a big deal in development deals. Y'all just Google it and learn about it that way, because this is not we need to catch on. We need to catch on like the big ticket items here.
And
But it's important.
Yeah, it is.
I've seen more in the fund structure. I don't do a lot of syndication, but I've seen more in the fund structure where, and this just kind of just boggles my mind, is that they'll call capital, they'll keep some sort of cash reserves on their balance sheet. And then if you look at the distributions you're getting, they're taking it, some of it's from net operating income that's generated, but a lot of it is just cash reserves being sent right back. So, their return profile in the first couple of years looks good, but you just realize that, hey, I'm getting a lot of return of capital. And like, why even doing that?
Well, I mean, you should be able to figure that out before you invest in that deal. And that's one of the big things that I like. In a fund, it's harder, I get it. But you should be able to figure out whether it's truly like they're paying your own money back to you, because if you look at the financials. But typically, what I like to see on a single asset deal, which is easier to see, of course, that's why I said you want to see the projections. I want to see the projections all the way down to investor cash flow, and then I know that the number that they're projecting in year 1, 2, and 3 is actually coming from cash flow, or they're projecting it to come from cash flow, and they're not raising money to pay me back my own money. Which you definitely don't want. So thanks for bringing that up. That's a good point.
All right, we're at time here. Hans, you want to just one last word of
I can
wisdom?
stick around for a little bit. Yeah.
Okay. Any other questions then we have?
We need more Anoops and ask questions. They're all
Yeah.
good.
I will say, I mean, when we started sort of reviewing pitch decks a couple of years ago, I used to do it all based on intuition. I feel like my processes of going through it now are much better because we don't have a choice now, because it's just hard to make deals work and you need to make sure that you're doing it properly. 5 years ago, it didn't. Anyway, yeah, well, Mike also has to hop off. Why don't we wrap with this? Hans, this has been awesome. Really appreciate you joining, man, and sharing all this. We do have a question here from Eric. What opportunities do you see this year based on your chats with operators? And secondly, how many deals do you think you will do this year?
What opportunities do you see this year based on your chats with operators? So multifamily is where it's at right now for us personally. There is distress in the multifamily market. We're in a contract right now to buy a deal where the seller is losing half their equity. They have an end of fund life and they got to get out of this deal. It hasn't done well. They didn't do a good job raising rents. There's a loss to lease play on this deal. It's a management play. We don't even have to do that much rehab. And we're buying at an incredible basis at like 75 a foot for a cash flowing 120 unit asset in a good metro. Multifamily is really where I see a lot of opportunity right now, Tuna, um, and that's because supply, as everyone could tell, has been really heavy. So it looks, there's worse occupancy right now, but supply is dropping off a cliff because of the interest rate rises over the last few years. And so in 27, 28, 29, everything we read and research, we already have a housing shortage. It's just going to be that much worse because nobody's starting new apartment builds really anymore because the debt got so expensive. So right now, multifamily that has a true value add component that cash flows, within a year at least, and then we just hold that for the next 5 to 10 years. That's where we see opportunity. And how many deals? I don't have any idea. It depends on how many good deals we see, right? I don't ever set a number of deals for us to do. It is, I only do deals that we like. And so if it's zero, then it's zero. If it's more, then we'll maybe try to do more.
Awesome. Well, I really appreciate you all for joining us today. Hans, I'm going to share your contact info with
Okay.
you. Share it here, and I'll show it in the show notes afterwards.
Yeah, yeah, maybe share it.
Yeah, really appreciate you, man. Thank you all, and thank you all for joining
Sure.
us. And we'll see you all next week. Another really interesting conversation we have with more institutional Anoop. So there's an institutional expert who's going to join us next week. Cool. Have a great rest of your week, everyone.